Understanding what happened to the American banking system this week requires looking at two numbers most people never pay attention to. The 10-year Treasury yield closed at 4.09% on March 2nd. That number makes headlines. Investors watch it. Economists analyze it. It represents the interest rate the U.S. government pays to borrow money for 10 years. But there's another number, one that doesn't make headlines, but determines whether banks can actually make money. Overnight repo funding costs hit 4.2% the same day. These are the rates banks pay to borrow money in short-term markets to fund daily operations. When you put those two numbers together, you see why regional bank stocks fell 5% in a single day, and why lending across America is quietly freezing. This is what analysts are calling the 2026 banking twist. The term comes from a specific market condition where short-term borrowing costs exceed long-term lending rates. Banks make money through a model that's existed for centuries. They borrow short-term from depositors and money markets. They lend long-term as mortgages and business loans. The difference between what they pay and what they earn is the net interest margin. That margin is profit. When short-term costs are 4.2% and long-term yields are 4.09%, that margin turns negative. Banks lose money on every dollar they lend. This is not theory. This is the mathematical reality facing American banks as of March 2026. To understand why this matters, you need to understand how banking actually works. When you deposit $1,000, the bank doesn't keep it in a vault. It uses your deposit to make loans. Maybe your $1,000 becomes part of a mortgage. Maybe it funds a business line of credit. The bank pays you 1% on your deposit. It charges the borrower 5% on the loan. That 4% difference is profit. But this model only works when banks can borrow cheap and lend expensive. When that relationship inverts, when borrowing becomes more expensive than lending, the entire business model breaks. And it's breaking now. According to analysis published March 2nd, the 10-year Treasury yield drifted to 4.09%, while short-term repo funding costs remained elevated at 4.2%. This creates what the analysis calls the antithesis of the traditional banking business model, which relies on borrowing short and lending long. The SPDRS and P Bank ETF fell 5% that day. The SPDRS and P Regional Banking ETF fell by the same amount. It was described as one of the most volatile days for financial institutions since the liquidity scares of 2023, the failure of Silicon Valley Bank, the crisis at First Republic. Regional banks are experiencing similar stress today, not from deposit runs, but from margin compression that makes lending unprofitable. The mechanics show up clearly in bank financial statements. According to that same March 2nd analysis, even megabanks like JP Morgan are utilizing AI to drive operational efficiencies that smaller regional banks simply cannot afford. But even these institutions are not immune to net interest margin compression, as the narrowing spread between what they pay on deposits and what they earn on loans eats into earnings. JP Morgan can offset some margin loss through technology and scale. Regional banks cannot. They lack the resources for massive technology investments, lack diversified revenue streams, and depend almost entirely on net interest income. When that income turns negative, these banks face existential threats. The yield curve shape determines profitability across the entire sector. In a healthy environment, short rates are low, long rates are high, spread is wide, profits are healthy. According to analysis from December 2025 titled The Great Normalization, the U.S. bond market had reached a historic milestone, the definitive end of the longest yield curve inversion in financial history. For over 3 years, that inverted curve served as a persistent warning of economic contraction. It finally ended in late 2025. Banks celebrated, margins expanded, financial stocks rallied into year-end. Then something changed. The Iran war began February 28th. Oil prices spiked. Inflation fears accelerated. Treasury yields moved, but in unexpected ways. According to analysis published March 5th, the 10-year Treasury yield climbed to 4.14% as investors found themselves trapped in what analysts describe as a Treasury yield pivot rewriting the rules of crisis management. Geopolitical escalation normally triggers a flight to quality. Money pours into government bonds. Yields fall. But the inflationary threat from spiking energy prices flipped the script. Markets sold treasuries instead of buying them. Yields rose instead of falling, but long yields rose less than short yields. The curve began compressing again, not full inversion yet, but dangerous compression that eliminates bank profitability. This creates a genuine paradox. During a normal geopolitical crisis, investors buy long-term bonds. Prices rise, yields fall, banks benefit. During this crisis, investors are selling long-term bonds. Prices fall, yields rise, but short-term rates rise even more because the Federal Reserve cannot cut rates while inflation threatens. The result is curve flattening that hits banks from both sides. Funding costs increase, lending yields can't keep pace, the margin disappears. Without margin, there's no profit. Without profit, there's no reason to lend. Banks that can't profit from lending simply stop lending. Evidence of this lending freeze is emerging across multiple channels. According to the March 2nd analysis, any further narrowing or sustained inversion will keep pressure on bank earnings. The banking sector is likely to remain under pressure until the yield curve finds a more traditional upward sloping shape. Until then, caution is the watchword. And for banks, caution means reducing risk. Reducing risk means reducing lending. Loan applications face extended review. Approval standards tighten. Rates on approved loans increase. Borrowers who qualified 2 months ago no longer qualify. Projects that would have been funded are declined. The credit tightening happens gradually. No dramatic announcements, just quiet policy changes at thousands of banks simultaneously responding to the same mathematical reality. The historical context makes this moment particularly concerning. According to analysis examining yield curve inversions from 1976 to 2026, 6 of 7 major inversions were followed by recessions. The mechanism is well documented. Banks borrow short, lend long. Net interest margin is their primary source of profit. When the curve inverts, that margin compresses or turns negative. Banks respond by tightening credit standards and reducing loan supply, not as a strategic choice, but as a profitability constraint. Business investment slows, consumer credit tightens, employment eventually deteriorates. The 12 to 18-month lag corresponds to the time required for this mechanism to propagate through bank balance sheets and spending chains. What makes 2026 different from previous inversions is the speed. Prior inversions developed over months as the Fed tightened policy. Banks had time to adjust, time to shift strategy, time to prepare. The 2026 twist occurred in days. The Iran war began February 28th. By March 2nd, compression was severe enough to trigger a 5% drop in bank stocks. By March 5th, long yields had risen to 4.14%, but short-term funding costs remained elevated, creating the narrowest spread since the inversion ended in late 2025. This rapid compression gives banks no time to restructure, no time to prepare for extended margin pressure. Bank of America provides a case study. According to February 27th analysis of the Great 2026 Twist, Bank of America, traditionally more sensitive to yield curve shape, has seen margins come under renewed pressure. Its significant deposit base is costing more to maintain as customers demand higher yields, while the retreat of the 10-year to 4.09% limits what the bank can earn from long-term assets. This has forced Bank of America to pivot toward fee-based services and wealth management to offset the erosion in interest income. Regional banks lack this flexibility. They have no wealth management divisions, no global trading operations. They are traditional banks, take deposits, make loans. When net interest margin falls below break-even, their options are limited. And according to the March 2nd analysis, regional lenders face a dual threat of compressed profit margins and a cooling consumer economy. A perfect storm. The phrase perfect storm appeared in analysis of SVB's failure in 2023. That collapse was triggered by a duration mismatch. The bank held long-term bonds that lost value when rates rose rapidly. Regional banks today face a different but equally dangerous problem. They must pay competitive rates for deposits while earning less on loans. The math simply doesn't work. Commercial real estate exposure compounds the problem. According to the March 2nd analysis, watch for an uptick in defaults within regional lender loan portfolios. Billions in commercial real estate loans originated at pandemic-era low rates are coming due for refinancing in 2026 and 2027. Property owners face massive payment increases. Many properties can't generate sufficient cash flow to support higher debt service. Defaults become inevitable. Regional banks absorb the losses. These losses further compress already thin margins. Banks facing loan losses and margin compression simultaneously enter survival mode. Minimal new lending, capital preservation over growth. The economy suffers as credit availability contracts. The Federal Reserve faces an impossible dilemma. Normally, when the economy weakens and banking struggles, the Fed cuts rates. Lower rates steepen the curve, wider spread, better margins. But according to the March 5th analysis, the Fed is currently in a state of suspended animation. Jerome Powell's term as chair expires May 15th, 2026. Uncertainty surrounding his successor has left markets without a clear Fed put. The belief that the central bank will always intervene when conditions deteriorate, that belief is wavering. New Fed leadership might prioritize inflation control over banking sector support. Markets must price this uncertainty, and higher uncertainty means higher risk premium on all dollar assets, including treasuries. Higher yields mean compressed margins. The cycle reinforces itself. Energy-driven inflation removes the Fed's flexibility entirely. According to the March 5th analysis, today's yield movements suggest markets no longer believe the Fed has the luxury of cutting rates if energy-driven inflation remains sticky. Oil at $80 feeds into transportation costs. Transportation feeds into everything. Food prices rise, manufacturing costs rise, services become more expensive. Core inflation captures these second-order effects. If core inflation stays above 3%, the Fed cannot cut without risking unanchored inflation expectations. The Fed will not repeat the 1970s, which means banks must endure margin compression until either inflation moderates or the geopolitical situation stabilizes and oil prices fall. Neither appears imminent. Reports indicate the Iran war could last 4 to 5 weeks, or, in Trump's own words, possibly far longer. Extended conflict means sustained oil pressure, sustained inflation risk, sustained Fed inaction, sustained curve compression, sustained bank losses. The timeline stretches from days to months. Historical precedents are instructive but imperfect. The 1994 bond market crash provides one parallel. The Fed raised rates aggressively to preempt inflation. Bond prices collapsed. Yields spiked. Banks absorbed mark-to-market losses. But the yield curve remained positively sloped. Banks could still profit from lending even while absorbing bond portfolio losses. The current situation offers no such relief. Banks face both mark-to-market losses on existing holdings and negative carry on new lending. The combination is worse than 1994. The 2008 crisis offers another parallel. Banks faced massive losses on mortgage-backed securities. Credit markets seized. Lending collapsed. Recession followed. But that crisis stemmed from asset quality deterioration, bad loans, fraud, speculation. The current crisis stems from yield curve geometry. The loans are good, borrowers are creditworthy, projects are viable, but the math doesn't work. Banks cannot lend profitably. This is in some ways more dangerous than 2008 because it affects all lending simultaneously, not just subprime mortgages. Auto financing, corporate credit, consumer loans, every category faces the same margin compression. The entire credit market freezes at once. The transmission to the real economy operates through multiple channels. Consumer borrowing becomes more difficult and expensive. Auto loan rates rise, credit card rates rise, personal loans become harder to obtain. Consumers facing higher borrowing costs reduce spending on big-ticket items. Car sales slow, home purchases delay. Consumer spending is 70% of American GDP. A meaningful slowdown guarantees recession. Business borrowing faces similar constraints. Small and medium enterprises dependent on bank lines of credit for working capital find those lines reduced or eliminated. Businesses that planned expansions cannot obtain construction financing. Commercial real estate development stops. All of this happens gradually. First, one business sees its loan application denied, then another, then another. The pattern becomes clear after months, not weeks. By the time the pattern is obvious, the recession has already begun. This lag between cause and effect is exactly why yield curve inversion is such a powerful recession predictor. The damage is done before anyone fully recognizes the extent of the credit contraction. Employment implications unfold over quarters. Banks facing margin compression reduce costs. First a hiring freeze, then attrition without replacement, then layoffs. Regional banks employ hundreds of thousands of Americans at middle-class wages in towns and small cities across the country. When banks contract, these communities suffer. Retail businesses lose customers. Real estate markets soften. The decline spreads outward from initial job losses. This pattern, replicated across hundreds of communities, creates a national recession. The process takes 12 to 18 months from initial compression to peak unemployment. We are at the beginning of that cycle, March 2026. The employment effects will manifest throughout 2026 and into 2027. Policy response options are limited. The Fed could cut rates to steepen the curve, but inflation prevents this. Congress could provide fiscal stimulus to offset credit contraction, but federal debt is already 100% of GDP. Additional stimulus risks, a bond market revolt, foreign investors losing confidence in dollar assets, Treasury auctions failing, rates spiking further, compounding the problem. Fiscal authorities are constrained, monetary authorities are constrained. The banking sector must navigate this without expecting a policy rescue. Some banks will survive, those with strong capital ratios, diversified revenue streams, sophisticated risk management. Others will fail, those heavily concentrated in commercial real estate, those with weak capital buffers, those unable to pivot away from net interest income dependency. The next 12 months will sort survivors from casualties. What to watch in coming weeks. First, the Senior Loan Officer Opinion Survey, published quarterly by the Federal Reserve. This survey captures lending behavior changes before they show up in hard data. If the April survey shows significant tightening, that confirms banks are responding to margin compression by reducing credit availability. Second, commercial bank lending data, published weekly by the Fed. Total loans and leases should show growth slowing or turning negative if the credit freeze intensifies. Third, corporate earnings from major banks. JP Morgan, Bank of America, Wells Fargo, all report net interest margin quarterly. If margins compress below 3%, these institutions face serious pressure. Regional banks with margins below 2% enter crisis territory. Real economy indicators lag but confirm the transmission. Small business optimism surveys capture sentiment before hard data deteriorates. Consumer confidence leads actual spending changes. Housing market data, mortgage applications, construction permits, provides another leading indicator. If housing and small business weaken simultaneously, the credit mechanism is fully engaged and recession becomes likely. International developments add complexity. If the European Central Bank cuts rates while the Fed holds, the dollar strengthens. If the Bank of Japan sells U.S. treasuries in volume, and Japan holds over $1 trillion of them, long-term yields spike further, worsening compression. The path of oil determines the path of inflation, which determines Fed policy, which determines yield curve shape, which determines banking profitability. Everything is connected. The Federal Reserve Chair transition in May adds a final wildcard. A more hawkish successor prioritizes inflation control over growth support. A more dovish successor reverses course. Markets must price this uncertainty until the appointment is confirmed. In an election year, political pressure for rate cuts intensifies if the economy weakens meaningfully. The Fed must navigate between economic necessity and political reality. The feedback loops between economics and politics become impossible to separate. The deeper structural reality is this: aging populations in developed countries create persistent demand for safe, long-term bonds. Pension funds and insurance companies buy long bonds regardless of yield to match long-duration liabilities. This demand keeps long rates structurally suppressed. Meanwhile, central banks globally cannot cut short rates aggressively due to inflation persistence. The result is sustained curve compression that traditional banking models were never built to survive. Banks that recognize this new regime and adapt will thrive. Banks that wait for a return to the old normal will perish. The phrase new normal is overused, but it's appropriate here. The yield curve shape of the pre-2022 era is not returning soon. Banks must accept this and transform away from net interest income dependency toward fee-based services, wealth management, diversified revenue. Those that resist will fail. Those that embrace it will define the banking sector of the future. Understanding all of this explains why 4.2% might be the most important number in the American economy right now. Not because it's historically high, but because it's higher than 4.09%. That 11 basis point difference means banks cannot profit from lending. Cannot profit means will not lend. Will not lend means credit contracts. Credit contraction means recession. Recession means unemployment. Unemployment means reduced spending. Reduced spending means business failures. Business failures mean loan defaults. Loan defaults mean bank failures. Bank failures mean financial crisis. This is not certainty. This is risk that grows larger every day. The curve remains compressed. Every day short rates exceed long rates is another day the banking system moves closer to a breaking point. And right now, as of March 5th, 2026, that breaking point is closer than most people realize. Not because banks are poorly managed, not because lending standards are too loose, but because the basic arithmetic of the banking business model no longer works when 4.2 exceeds 4.09. That is the yield shock. That is why banks are freezing loans. And that is why the next 12 months will determine whether the American economy avoids a recession that historical patterns suggest is already overdue.